FD or stock market, the real story of higher returns. At around 10 o'clock at night, a man was looking at his FD receipt. The interest rate was clearly written on it, the maturity date was clearly written, and the money felt safe. But in that same phone, a message from his friend arrived. I had invested money in the share market, the investment has more than doubled. That line shook his peace. The fear begins right here. If all the money is kept in an FD, inflation will eat it up. And if it is invested in the stock market, what if the capital itself sinks? The curiosity is exactly this. Can the stock market really give higher returns than an FD, or is this just a shining story of a few lucky people? Today the methods of investment have changed. Earlier people used to say, keep money in the bank, make an FD and keep taking tension-free interest. An FD is important even today because it gives stability. But today's investors do not look only at safety, they want growth too. This is the reason why interest in the share market has increased rapidly. In 2025, the number of Demat accounts in India had reached around 20 crore. So many new investors came into the market because they felt that it is difficult to build wealth without moving ahead of traditional saving. But entry into the stock market is easy, success is not. Opening a Demat account is a matter of a few minutes, but building the right investment mindset demands years of practice. While comparing an FD and the stock market, first of all, it is important to understand that the work of both is different. An FD gives safety and predictability, the market gives growth and uncertainty. In an FD, you know in advance approximately how much money will be received on maturity. The interest is fixed, and emotional tension remains low. But the return of an FD is limited. If inflation is high, the real return, meaning the actual purchasing power, can reduce. In the stock market, the return is not fixed. Here, the price changes every day. Sometimes the portfolio looks green, sometimes red, and this very volatility scares new investors. But in the long term, good companies and diversified equity investments can help in wealth creation. This is the reason why people think beyond an FD. The stock market does not mean just trading. Many people understand the market as a game of buying and selling every day, but investing is different from that. In trading, speed, timing, and discipline are needed. In investing, patience, research, and business understanding are needed. If a person buys shares without knowledge, just on tips, they become a guesser, not an investor. The first lesson in the market is research. In which company to invest money, why to invest, and what is the earning capacity of that company, it is important to understand this. A company's business model, debt, profit, cash flow, management quality, industry trend, and valuation, all these matter in an investment decision. Investing money just by looking at a famous name is not safe. Sometimes a famous company is available at an expensive valuation, and growth is already included in the price. On the other side, a small unknown company might look cheap, but it can have higher governance, liquidity, and business risk. This is the reason why beginners should stay away from penny stocks. A share of 5 rupees or 10 rupees looks cheap, but a low price is not value being cheap. Penny stocks can go up rapidly, but they can fall down just as rapidly. Many times, there is a danger of operator activity and low liquidity in them. Companies like Rolta India gave hope to investors at one time, but later, situations like financial stress and the insolvency process showed big losses to people. Therefore, do not look only at past returns while choosing shares. Past return is a mirror, not a future guarantee. Some shares like BSE Limited showed excellent returns in different periods, but every stock does not become BSE and every high return does not repeat. The most dangerous line in the stock market is, it has given this much before, it will give in the future too. Market history demands respect, not blind faith. If an FD gives you fixed returns, the stock market gives you possibility. But along with possibility, risk also comes. SEBI also reminds investors that investment in the securities market comes with risk, and one should be careful of promises of guaranteed returns. The first practical strategy to earn higher returns in the market is long-term thinking. In the short term, price runs on noise. In the long term, business performance becomes more important. If you want to double your money in 3 months, the market can teach you a lesson very quickly. But if you keep a horizon of 5, 10 or 15 years, the role of equity can be stronger, especially for wealth building goals. The second strategy is staggered investment. Putting a big amount into the market all at once can be risky because the entry timing can go wrong. If you invested the entire money at the peak and the market fell, the emotion can break. Therefore, investing slowly remains better for many people. An SIP is a simple form of this very mindset. A fixed amount gets invested every month, which builds discipline and reduces the pressure of market timing. An SIP too does not give guaranteed returns, but it gives the investor the habit of regular investing. A habit is very powerful in the market journey. The third strategy is diversification. Putting the entire money in one stock, one sector, or one theme is dangerous. If there are only banking stocks in the portfolio, and the banking sector comes under pressure, the entire portfolio will shake. If there are only small caps, the damage can be more in a fall. If there is only one hot theme, the confidence can break as soon as the theme cools down. Diversification means dividing money among different companies, sectors, and asset classes. This does not eliminate risk, but the ability to absorb shocks increases. Both FD and equity can keep a place in the portfolio. An FD can come in use for emergencies, short-term goals, and stability. Equity can come in use for long-term growth. Meaning the fight is not FD versus market, it is of the right allocation. If you need money in the next 6 months, that money should not be in a risky stock. For a short-term goal, safety comes first. If there are long-term goals like retirement or children's higher education, then equity allocation can be considered wisely. The fourth strategy is not to fear a fall, but also not to buy blindly. Buy the dip is a famous line, but every dip is not an opportunity. Sometimes the market falls temporarily. Sometimes there is genuinely a problem in the company's business. Understanding the difference between the two is the work of research. If a strong company has fallen in temporary market panic, it can be an opportunity. But if a weak company is falling, that can be a warning too. New investors often sell immediately upon seeing a fall. Then they regret when the market recovers. But some people make the opposite mistake too. They keep averaging every falling stock and keep trapping money in a bad business. Therefore, it is important to stay calm in a fall, but not blind buying. Ask the question, is the thesis intact or not? The fifth strategy is profit booking and rebalancing. Greed stops investors. Even on having a good profit, they say, it will go a little higher. Many times, profit truly increases. But many times that same profit slowly disappears because the investor does not make an exit plan. If some stock has taken a very big weight in the portfolio, partial profit booking can be sensible. Rebalancing means bringing the portfolio back into the planned proportion. This controls both greed and fear. The sixth strategy is avoiding investing by taking credit. Putting money in the stock market by taking a loan is very risky, especially for beginners. If the market falls, the investment value will also reduce and the loan EMI will also keep running. This can become a double pressure. Put only that money in the stock market which is separate from the emergency fund, basic expenses, and short-term needs. Emergency fund first, insurance protection first, high-interest debt control first, and then a step toward investment growth. The seventh strategy is staying careful of tips, rumors, and social media hype. Today, in every second reel, some stock is told to be a multi-bagger. But the confident voice of some unknown person cannot be a substitute for financial research. If someone is making a pressure of guaranteed profit, sure short return, insider news, or urgent buying, then become careful. The desire to get rich quickly in the market often opens the way to become poor quickly. In an FD, your main risk can be of lower returns and inflation. In the stock market, there is a risk of capital loss, volatility, and wrong selection. Therefore, the decision will depend on your age, income, goals, risk tolerance, and knowledge. If you cannot sleep all night upon seeing risk, then aggressive equity allocation might not be right for you. If you are young, have a stable income, have an emergency fund, and have a long-term horizon, then equity can gradually play a role in your portfolio. But do not make the share market entertainment. This is not a casino, it is a market of the ownership of businesses. Behind every stock, there is a company. Behind every company, there are customers, employees, debt, competition, margins, and management decisions. When you buy stock, you do not buy just a chart, you buy the future earning story of the business. Therefore, a good investor understands the business more than the price. They ask, how does this company earn money? Will its product remain in demand in the future? Is the management trustworthy? Is the debt under control? Is the valuation not too expensive? The mutual fund route can be easy for beginners because professional fund managers and diversification are found there. Index funds too can be a simple option for broad market exposure, where you escape to some extent from the pressure of single stock selection. But mutual funds too are not free from market risk. While choosing a fund, it is important to understand the goal, category, expense ratio, risk level, and time horizon. While shifting from an FD to the market, do not change the entire money all at once. First, learn with a small amount. Your real personality comes forward when the market falls. More important than book knowledge is what you do upon seeing a red portfolio. If you panic sell, then reduce allocation. If you can review staying calm, then experience will increase slowly. In a practical portfolio, there can be a mix of FD, liquid fund, debt instruments, equity mutual funds, and direct stocks. But this mix will be different for every person. Someone's income is stable, someone's business is seasonal, someone has more family responsibility. A copy-paste formula in investing is dangerous. It is not necessary that a friend's portfolio is right for you. Now we come to the final question. FD or stock market, where will higher returns be found? The answer is simple too, and complicated too. In an FD, the return is predictable but limited. In the stock market, the return can be higher but not guaranteed. For the investor who keeps research, diversification, patience and discipline, the stock market can become a better path of wealth creation than an FD in the long term. But for the investor who runs on tips, greed, loan money and panic, the market can prove to be not better but more dangerous than an FD. In the end, the real difference is not in the investment product, it is in the investor behavior. An FD gives you the sleep of safety. The stock market gives you the opportunity of growth. A smart investor understands the place of both. If you want higher returns, just love for risk is not enough. Understanding, managing and respecting risk is also necessary. Because the market rewards those people who keep patience and punishes those who look for shortcuts. Today the decision is not that one has to leave the FD and jump into the market. The decision is that one has to make the right balance according to their financial goals. When safety and growth run together, then your money will not just lie in the bank and will not just stay scared in the market either. And this is the real story of smart investing. If a big return is needed, a big mindset is needed too, but the step should always be taken wisely.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.